Welcome to Opal's TV. Today I'm in Paris together with Cyril Juillard and Olivier Kingen. They are the two founders of Eraam, a company they set up in 1998. Now Cyril, please give us a bit of your background and what are you doing at Eraam?
In 1998, I decided to found Eraam. We decided to set up to help investors to know better their hedge fund space. So we decided to do that through fund of fund, which was very classical. We think that the investment into a hedge fund, it's important to have a good qualitative due diligence. And that's why we decided at Eraam to focus on Europe space. So we do only investment with European-based hedge fund manager. This is the mainstream of Eraam at the beginning. Since the business model has evolved in time, so we started with commingle mandate, very classical, and then we've been through dedicated mandate to large institution. That was the part from 2002 to 2008, and then following the crisis of 2008, thanks to our good manager selection, we did not face neither a blow-up, nor gate, nor side pockets in our hedge fund business. But nevertheless, the investors changed their view of the fund-of-fund business. So we have started here with Olivier since 2008 to evaluate our style of management. So we are now more focusing to small managers, emerging managers, and dedicated product to institutions. Here at Eraam, we like to take risk. So you have to consider the fund of fund makes sense to us only if individually you take risk into the investment that you do and you mix them into a fund of fund. So our style is concentrate funds, European-based and volatile underlying manager individually, because the large institution for whom we're working and dedicated mandate that we do have won't go in direct to this kind of strategy in their portfolio. So they still like to do it through a fund of fund. That's how it makes sense to us.
So my name is Olivier Kingen. I had a background of prop trading at a large investment bank in Paris and London. And I must say that it was my first step into the asset management industry. In the meantime, I had the opportunity to have an experiment of a hedge fund launch myself with a CTA manager that I branded and started in '98. It was a very helpful position in order to come into the fund of fund industry because we went through the experiment of setting up a fund, launching it, facing the difficulty of raising assets at the time, and being exposed to the same problem as the managers that we see today. So it was quite important for me and for Cyril to have this entrepreneurship understanding. We are not, typically, to complement what Cyril said, we are not a distributor of brands from the US into Europe. We are truly, genuinely asset managers. We are portfolio managers. We are trying to pick and choose the right strategies. So we make an effort, I would say, in thinking about the drivers of the strategies, what can hurt them, what can make them with a tailwind or headwind. And then again, we add a layer, I would say, of alpha, what I think is considered as alpha, in the manager selection, by going really looking for those guys which we think are hungry, which we think are really able to preserve on the long term this alpha, and people whereby we can, I would say, not making deals, but making a good compromise in the fee structure. Because one of the things that struck me when I came into this industry back in '99 was a very important layer of fees that we had to combine between hedge fund and ourselves. It was a world of interest rate much higher, So, and we had managers in the 90s hitting the 20 plus, which I think was okay for a 20 structure. Very soon, the rates have come off, and I saw that having no hurdle, having no such performance fee, was not something that could live through a long cycle, basically. So Cyril and I, we had the opportunity, in a way, to get the support of a large institution in the US as our main client, and it gave us some bargaining power. In the meantime, actually, there was a problem in Europe with managers having difficulties to raise assets because the support of the institutional network in Europe was weak, and the support is still actually very much US for launches in Europe. So with those managers having difficulty to raise assets, we have made creative structures, and we have created creative fee structures, which we think going forward should be very positive for the reconciliation between institutional money and hedge fund capabilities. So that's, I would think, a very important part of the model that we are going forward.
You have been running money for CALPERS, the big Californian pension fund, for 8 years now. So during the time, what has been your experience?
We have been selected by CALPERS after a long process. We started in 2005 and we started the mandate in 2006. The rationale for CALPERS was to select partners outside of the US for their investment into their hedge funds. So they selected in 2005 3 managers in Asia and 3 managers in Europe. We were one of those 3 managers and the smallest one. The rationale for them was that they wanted to have local presence in those areas to help them to diversify their portfolio and their exposure. So as I said, we were the smallest of the managers, and we have built for them a portfolio which started with $35 million and which is now $300 million. After 8 years of partnership with CALPERS, because it was a partnership, we have been we were the best performer in the fund of hedge fund program over those past 8 years, and we were the smallest company, which is the most interesting fact. We were even better over the past 3 years and 5 years than their direct hedge fund allocation portfolio. So why that? Probably because we like to go through emerging manager, and the risk-return profile is different with the emerging manager. It's not easy for a large institution to go through emerging manager because of the process, the historical, the due diligence. It's quite complicated. So I think that makes sense for a large institution to delegate this part. Regarding the performance that we have achieved for them over the past 8 years, the mandate, so that includes 2008. The mandate was Merrill Lynch risk-free rate plus 500 basis points, and we have achieved Merrill Lynch plus 450 basis points over the past 8 years. So we were in the mandate. In terms of concentration, we have invested within, on average, 15 managers, and the benefit as well of having the support of a large institutions is that we've been able to negotiate the fees, management fees, performance fees, governance of the funds. Even in some case, we enter the board of the funds without receiving any remuneration, but we consider that we were better by being in the board of the underlying funds to defend the interest of our investors. So CALPERS has agreed for us to do that, and it has been pretty successful.
To add something about the relationship with CALPERS and the experience, I would say that it was a two-way relationship. And Cyril mentioned the word partnership, and I think it's very important for us to mention that to our prospective clients. We are not in the business of distributing our product. We are in the business of trying to find solutions for our clients. And we believe that the hedge fund community can provide a solution to certain problems. It's not a one-fit-for-all solution. It's complex and a very heterogeneous universe. You have to have people to help you and pick up. So the philosophy of CALPERS was, I think, pretty right. I think in Europe, you have a very large funds, very established largest fund, and I don't think people need really Eraam to do this kind of selection. It's very well covered by consultants these days. We can discuss the value added of a Titan fund in a fund-of-fund portfolio. It's another probably topic, a long topic. We always decided to combine those two elements, and we had a very good transparency. It's very important to say that since 2006, we are able to aggregate all equity security level transparency. That was one of the prerequisites of CALPERS, and not a lot of managers would agree to give the short book line by line. And we managed to do that, okay, because we had CALPERS behind this. And this is quite important, I think, when you do good portfolio management. After all, we are asset managers, to understand the granular risk into your portfolio. And that was very well appreciated by CALPERS, because in 2008, we had a very close contact, monthly calls. And that's very important as well. You don't just give a mandate, I think, to someone and just wait for the numbers. CALPERS was proactive in asking us, challenging us for every investment they could veto, and also asking us about, forecasting of performance and risk. And in 2007, Cyril and I, we identified a very big risk on the event-driven and credit space, and we took the risk of de-risking the portfolio. We just had the mandate, we de-risked it. So it was kind of a challenge, but because we had this close dialogue with our counterparty at CALPERS, we could really understand what we should not do. And what we should not do was losing money with the equity group, because the sponsor of this program within CALPERS was the equity group. So we rebalanced totally the portfolio, and we managed to lose actually 1% in 2008, which was, I think, top 5% of the fund-of-fund industry, and we had a big mandate at the time, so it was remarkable performance. And that's how we build the confidence. If you listen to your client and you understand what he says to you, it's much easier to overperform the averaging of the industry. Okay, so it's a very important lesson of experience, I think, for people who are giving mandates. I think is just keep the communication very clear on what are your goals within this industry. You can get a lot of widespread returns doing with hedge funds. But if you are very clear to your asset manager on what you want to do, this industry can give you the mean to achieve your goals.
So please tell us more. How do you succeed investing in emerging managers?
At Eraam, we like emerging managers for many reasons. The first one is we consider that forward-looking into the investment is qualitative due diligence is the most important. And to do a good qualitative due diligence, you have to have a strong network of informations. The guy who is launching a hedge fund today doesn't come out of the blue. He is coming from different areas in the finance sector. And us at Eraam, because all the partners have done their career in the investment banking in Europe, we are able to have qualitative information on the guy at the very early stage. So that is securing our investment. Second point is that emerging managers have smaller assets. And over the past few years, it's much easier to perform with a couple $100 million under management than with a couple billion of dollars under management. So us, we consider, and this is our history, even in 2008, where we faced the crisis of the hedge fund industry, the only issue we had with some hedge funds was with large and established hedge funds. We never had issue with small or emerging managers. And why that? Because they had lower assets and also because it's an entrepreneurial business. And us at Eraam, we believe more in individuals than in company or structure. So if you consider that an entrepreneur is starting a business, he's really focusing on his business. It's an ego business, there is a strong ego as well. So the guy wants to prove to everyone that he's doing well or not bad, I would say. And all that put together makes that the investment, if it's well done with the qualitative due diligence, it's safer, I would say, with emerging managers than with established managers. Okay. Point number 2, the drawdown. If you invest with an established manager after, let's say, 3 years of track record, you're investing with him because he has a good track record. With consider that you invest at the year 3 or year 4, then you can face a drawdown in the fund, which is happening, which is not very pleasant when you are a new investor. But it's not a disaster for the fund manager because he has already a 3 years track record. But for you as an investor, it's not good. If you consider investing at year 1, the manager is so much focusing that he won't do drawdown. The worst happening is that he doesn't perform because he's tightening the risk too much. That is the risk of investing at day 1. And the other risk we see at investing in day 1, which is not a risk for us as an investor, is that the team, the fund manager is building his market for whatever, for many reasons, it doesn't work. So it doesn't work means that after 1 year, if he doesn't perform well or if he's not happy with his team or with his staff, he just quits. And when he quits, he says, he's giving you back the investment. And we rarely face drawdown, really rarely. The biggest drawdown we had was with established manager.
What I want to add to what you just mentioned in terms of research and monitoring, because it's part of my area, I would say, I find it much more easy to deal with risk monitoring when I have a face-to-face meeting with a manager. The problem very often with your very large manager is that you will meet an investor relation, which is a very talented person, but I mean it's always better to be eye to eye to a manager, especially in the case of stress, which can happen in this market, to understand mostly how he is sensitive to his shareholder. Understand those things that are not market related but are emotion related, and we think it's quite important in our thought process, if you want. So the transparency is giving us a very good element of simulation. We can simulate our portfolios, and we can make stress testing, and we can do a lot of things that can address in the committee when we take our decision. We don't only speak about the market is good or bad for that manager. We say how much can we lose, and we try to put a number on this, which is not an easy exercise. But our analysts have been educated to that difficult game, and it's been quite fortunate to have this in our hands and consolidate it in the risk management process. The one thing that I want to add maybe is about being not a seeder really, because we are not really seeders yet. We need to have lock-up capital in order to do that, which we are happy to have, but we didn't find the support for it. But we are in the day 1, I would say, investing business, which is a bit different. Why is it different? The key difference is we are free with our money. You can make a deal day 1 with a manager on fees, transparency, whatever, but you never know what can happen in life. And if you are a seeder and these things go wrong with your fund, you are locked in typically at least 3 to 5 years with that manager, and you keep the bad performance with you. At Eraam, we want to be free of our investment, and we can be wrong. I mean, we are human beings. The experience that we have invested 285 managers from the last 10 years, roughly, with a turnover on average of 27 months. The average extra performance from funds that has less than 1 year track record from the others was roughly 3% in almost every strategy but CTAs. Okay, so extra value added by selection of people early stage. So it's quite a significant number. I think in worlds where the cash, the performance is around 5 to 6% in the industry. That's a very important point, I think. Then the seed structures put you in the economic capital of a company, so you are becoming more like a manager of a company. We don't want to be that. We are asset managers. But what we do is we respect the barrier to entry for each strategies, and we can understand that for such strategy, a manager will require a protection of a minimum of revenues. So we are not fighting for the lowest fee day one. It's not systematic, I would say. In very low barrier to entry, yes. But in high barrier to entry, we respect that. What we suggested 3 years ago, we've made 3 deals like that, is typically to have an AUM growth deal, whereby if the manager has triggered to raise assets above a certain level, our management fees and performance fees goes down. And that is a win-win game for the manager and for us. So I think this is more of the thought process here at Eraam in Europe in our current environment.
So in your view, how is the fund-of-fund industry, how is the business model evolving?
So we think that the future of the fund-of-fund business is evolving a lot and will survive under 2 conditions. That first one is that you bring value. Second one, you bring value at lower cost to your investors. So how do we consider that we bring value to our investors, very large investors, is by selecting, as we mentioned earlier, emerging manager, able to do fees, deal, exposure, and transparency. On the top of that, we consider that the second aspect is the hybrid, what we call hybrid fund of fund. For instance, as we like to go to emerging manager, we consider that we can identify specific theme of the market and spot the right manager for the specific theme and ask him to start a fund for us on a specific theme. So we are able to manage the fees. So in the case of the final investors, going direct to a hedge fund or to a fund of fund should be the same price, and the managers understand that. And secondly, on the top of that, and this is a hybrid things, we can leverage some ideas of the underlying manager because it is a dedicated fund. We can leverage some ideas by direct co-investment with the managers. And in that case, you bring a real diversification, there is no extra cost for the managers, and we go through funds or manager where the large institutions won't go because it's too much work, too much detail for them to do so, and this is where we bring diversification and value we consider to our managers. We have launched a product with the support of a very large investors, and Olivier will explain that to you in details.
So when we came into the European opportunities and made pitch into the US, especially 3 years ago, we faced some difficulties to attract the attention of people because of these complexities of the European markets. We felt that it was a tremendous opportunity in the fixed income credit area, and we decided to go and see some investors that wanted to deploy capital into Europe, but felt that was not enough granularity in the expression of this opportunity. Typically, Till now, the American money was flooding through the distressed pack of investors, but this distressed pocket was a global mandate, not a pure European mandate. When we look and discuss with manager, we realize that there was a lot of opportunity in niche strategies, mentioning just for instance ABS or legacy CLOs. Those strategy was completely abandoned by the traditional investors in Europe. And for very simple reason, regulation. Insurance company could no longer buy structured credit without being penalized for ratios. Same for banks, no more distribution to retail, etc., etc. So there was a mispricing in the market. This mispricing, we explained it very cautiously to some people who did not want to use fund of fund. And that was our challenge. How could we sell something in the fund of fund format with people who don't want it but would like the trades? So how we tackle this is basically by creating dedicated funds with managers for that investors and packed it in a product whereby we have compressed fees at very, very, very aggressive levels. Okay? So what we suggested to that investors in order to be comfortable with our board was to say that there was an all-in management fee look-through basis capped, including our fees. And going through the additional of manager fees plus our fees, they were getting nearly a lower fee than any other classic specialist credit managers. So that was very competitive, and we tackled the fee layer fee structure problems that people face in that business. Then we also negotiated a lot of hurdle rates and limited performance fees. Moreover, because we created new funds, that was also an opportunity for those managers to establish a track record. That's how we made it a deal, if you want. And we have also the benefits of AUM growth there. Now, we think this is very emblematic of the kind of solution a specialist can offer to a globally based investor who wants to deploy money, but not on an asset class, because hedge funds are not an asset class per se. They want to play a theme. If you want to play a theme in Europe, why don't you call us? And we find solution, be it an equity and credit. And with this solution, might combine hedge funds, or maybe be 100% hedge fund, or combine other classic, traditional, long-only manager, because we select everything. We are in the business of creating value, as Cyril pointed out. And I think with the level of rates today, very difficult to think about without, I would say, alternative specialists in order to reach a certain level of return in the coming world. So we want to reconcile, I would say, probably the excess layers of fees with the opportunity set that is provided to investors who are still shy with the concept of fund of fund.
So you focused on Europe with your investments. In your experience and in your outlook, what's the opportunity set now and say midterm for Europe?
So where we see the opportunities today in Europe is more on everything the credit space. We think the banks in Europe are still very leveraged. They have not been to the point where the US bank has been over the past 3 years. So the deleveraging is to come in Europe. So the opportunities are just starting while the banks start to sell the stress book or the bad loans on their portfolio. But Europe is a fragmented area, so you have to be very local. So the opportunities in France are not the same one than those in Spain nor those in Germany. So that's why this process is taking much longer time than it has taken in the US. And this is why we consider that from now, for the next 3 years, there is, for the credit investment space, a lot of opportunities that will come on the market, but there will be small opportunities. So you must be flexible, nimble and small to size some opportunities, sometime in Germany, sometime in France, sometime in Italy, and you have to know very well the European space, and we think we are well placed to do that.
Yeah, I mean, the The sequence that we have identified for this trend to happen is materializing very recently with the announcement of the ECB very clearly. Part of what we have done for our investors is manage to buy a number of legacy RMBS and MBS in Europe in the last 12 to 18 months. And obviously, in a month like September this year, it's a very profitable trade. I mean, this was a very asymmetrical trade, and I think there are more trades like this to come. What people need to understand is that it's very different from the capital market in the US. We have a booming European high yield market. It's tripled in size. It's still much smaller than the US market, but the trend is for bank lending to be cut and for capital markets to be more efficient. The culture in Europe is not yet there, be it retail or institutional. It's moving in the right direction, okay? The regulation, the repression which is happening into banks and insurance companies, which are the main drivers of those instruments, securities, the main people capable to buy those securities, is going to be a bit still confrontational with regulators. Between the ECB and the regulator and those institutions, it's still very a frozen situation. Nothing is really happening. So we think this opportunity can last, and that the gap that has closed very quickly in the US, because they have a very professional circuit of distribution, is not yet there in Europe. So we are optimistic that not only this trend is here, but it will be slow to bring the gap. And we think for that, the private debt market is opening up very widely going forward. Now, you have to source the deals to the banks. You have to source the deal with private investors. You have to source the deal very softly, very discreetly. There is regulatory capital arbitrage also available for you, but nobody wants to advertise. So, I mean, you need to do bespoke transaction. And to do those bespoke transactions, what we offered in our product is not only to have those managers who can do those transactions, but also we now tend to propose co-investment to our current investors, because we think that they are happy to have this transfer of experience, this intelligence, if you want, but maybe sometimes they want to leverage more on certain acts of the niche credit markets than others. So we want to be super flexible. It's costing a lot. There are barriers to entry to doing this. We are spending a lot of time setting up dedicated structure today. But those vehicles now are established, and we think going forward, we are not short of ideas. We have a lot of co-investment ideas right now, and there is a lot of growth going forward for us.